The next question is, explain the expression round trip financing in relation to impermissible avoidance agreement. So you can refer this in our chapter, GAR chapter. The next question is, Mr. Manish and company, a proprietary concern of Mr. Manish, failed to furnish the return of income for the relevant assessment year within the due date. The AO in turn lodged a complaint against the proprietor under section 276 CC. So in case if the person fails to furnish the return of income as per the due date which has been specified under 139(1), then he can be liable for imprisonment proceedings under section 276 CC. And in case where the amount of tax which would have been evaded if the failure has not been discovered exceeds rupees what 25 lakhs, then there can be a rigorous imprisonment for a term which may extend to 6 months, from 6 months to 7 years, and with fine. So here imprisonment can be from 6 months to 7 years and with fine, where the amount of tax evaded on account of non-furnishing of return exceeds rupees what 25 lakhs. And in other cases, it should not be less than what 3 months, but which may extend to 2 years and with fine. Okay. Now here the tax payable on the assessed income is reduced by the TDS and advance tax was 165. So here he falls under this category. Mr. Manish filed an appeal before CIT appeals against the order of assessment and got a part relief. According to AO, passed an order giving effect to the order of CIT appeals, and the tax payable, AO has given the effect of the order of the CIT appeals, and the tax payable now works out to be 8,500 rupees. So here it has been provided that no prosecution proceedings can be lodged. No prosecution. If the assessee has furnished the return, if the assessee has furnished the return, the ROI, before the expiry of assessment year, before the expiry of AY, or say the tax payable other than company assessee, say on the total income determined on regular assessment, reduced by what the advance tax or the self-assessment tax, if any, paid before making the expiry of the assessment year, and the TDS and TCS does not exceed rupees what 10,000. So here the tax payable other than company assessee does not exceed rupees what 10,000. Does not exceed 10,000. Where this 10,000 has been worked out, here tax that has been assessed as reduced by what? The advance tax, self-assessment tax, which is paid before the expiry of assessment year, and TDS and TCS. So in this case, the tax amount just works out to be 8,500 rupees, and this has been accepted. So in this case, these prosecution proceedings cannot be maintained against Manish and company. And in case, what would be your answer if instead of Manish and company, it is a private limited company? For company assessee, prosecution proceedings can be launched. Prosecution proceedings can be launched irrespective of the amount of tax. So even if it is below 10,000 rupees also, then also prosecution can be launched. So in this case, in the first case, when the final assessment order was made by the AO, in pursuance of the order of CIT appeals, the tax amount does not exceed rupees 10,000. Therefore, prosecution proceedings could not be launched. But in the second case, when it is a company assessee, prosecution proceedings could be launched in such a case. Now next is Mr. Lal Singh created Lal Singh Welfare Trust in June 2019 by duly executed in writing a trust deed. Now he has created a trust and he has appointed Miss Vinita as a trustee. So Lal Singh is there Trustee is the author of the trust. Trustee is Vinita. Vinita is the trustee. And the trust was created to take care of old parents. Beneficiaries are whom? Beneficiaries are old parents and his two uncles, both being older brothers of his father. Old parents plus two uncles. Okay. Where all are dependent on Mr. Lal Singh. They are what? Dependent on Lal Singh. And continue to live together in their native village in Rajasthan. The income arising out of the assets of the trust is to be allocated amongst the beneficiaries each year as per the sole discretion of the Miss Vinita. So here it is a discretionary trust. It's a private discretionary trust. Private discretionary trust. It is about basically private discretionary trust. And here shares of beneficiaries basically are indeterminate. Shares of beneficiaries are indeterminate. So we have seen in case of private discretionary trust where shares of beneficiaries are indeterminate, the taxation is met with the maximum marginal rate, normal circumstances. But here the beneficiaries to the trust have no other source of income. So in this case, if a trust has been created and the trust has been created through a duly executed instrument in writing and it is for the benefit of relative dependents. Trust is for benefit of relative dependents. The trust is for what? The benefit of the relative dependents here. And none of the beneficiaries have what? The income. None of beneficiaries has income. As income exceeding maximum amount not chargeable to tax. So we have discussed the same as per the provisions of section 164(1). In 164(1), the applicable tax rate will be AOP, that is slab rate will be applicable in such a case. Slab rate applies in such a case. Now here the income of trust during the previous year is 1920 is 10 lakh rupees. So in this case, when the beneficiaries are there, their shares are not determinate. It's a private discretionary trust and the beneficiaries do not have any other source of income, then the applicable tax rate will be what? Slab rate. In that case, on 10 lakh rupees, slab rate will be applicable. For first 2,50,000 will be taken as nil, and next 2,50,000 will be what? 5%. That is 12,500, and next 5 lakh it will be what? 20%. That is 1 lakh rupees, and it will be increased by HEC. HEC at rate of 4%. The effective tax liability works out to 1,17,000 rupees. Then this is the tax liability of the trust. Would your answer be differ if the father of Lal Singh has been receiving a monthly pension of 25,000 rupees apart from the income? Now here his father Lal Singh is receiving monthly pension of rupees 25,000. So he is receiving pension of 25,000 into 12. 3 lakh is the pension. 3 lakh is the pension. We gave a standard deduction of 50,000. It is 2,50,000. Here also the the beneficiaries has, none of the beneficiaries has now the income exceeding what? Maximum amount what? Not chargeable to tax. So they are not having the income exceeding maximum amount not chargeable to tax in case a standard deduction has been provided from this pension income. Then otherwise, if the income enhances, it exceeds the maximum amount not chargeable to tax, then in that particular circumstance, the maximum marginal rate would have been levied. But here, since the income, none of the beneficiaries has other income exceeding what maximum amount not chargeable to tax, neither is the beneficiary under any other trust, then in that particular circumstance, AOP rate will be what applicable. So this was one question which we have discussed about private discretionary trust. Next is during the previous year 1920, Miss Sujata, during the previous year 1920, Miss Sujata, citizen of India, is resident of both India and a foreign country with which India has a DTAA, which provides that the income would be taxable in the country where it is earned and not in the other country, but will be included for computation of rate purposes only. So we have to include the income only for computing the tax rate. Though it won't be what? Chargeable to tax, it will be included only for the purpose of, say, rate computation. Now our income is 5,75,000 from business in India and 14 lakh from business in foreign country. In foreign country, the rate of tax is about 20%. And during the previous year, she had paid a premium of 35,000 to ensure the health of her mother. She is non-resident, aged 83 years, through credit card. Now, deduction will be restricted to 25,000 only because she is though she is of 83 years of age, but she is not senior citizen. For senior, very senior citizen or senior citizen, the person must be resident in India, but she is not resident. Therefore, the limit of deduction will be 25,000. You are required to compute the tax payable by Ms. Sujata in India for assessment year 2021. Also show the tax payable by Sujata in India had there been no DTA. Now they are asking for two questions. One is the agreement exists, and in case other cases what the agreement does not exist. In case the agreement does not exist. So I think the marks awarded must be 6 marks is the question here. So let us discuss now this. Says in situation 1, when DTAA exists, when we are having a double taxation avoidance agreement, in this case, the income will be included only for the purpose of rate purposes, for computing tax rate. So, what is the income? Business income in India. Business income in India is 575. Then, income from business in a foreign country, business income in foreign country, it is 14 lakh rupees. Okay, this is included just for rate purpose only. It is 19,75,000 less deduction under section 80D. There is 25,000 deduction. So it works out to be 19 lakhs. Now we are computing the tax rate. Computation of tax rate. From first, now look what is the, whether she is a senior citizen or not, clarified. Sujata is a citizen of India, resident, nothing about her age. Mother's age have been provided. So here, on 2,50,000, it is nil. Next 2,50,000, it is 5%, 12,500. Next 5 lakh, it is 20%, 1 lakh. And on balance 9 lakhs, it is what? 30%. So this works out to be 270. So the total tax works out to be 2,70,000 plus 112,500, 382, 500. Then add HEC at rate of 4%. That is 15,300. So it is 397,800. Now what is this will be included only for the purpose of computation of tax rate. Now tax rate works out to be how much? On 19 lakh rupees, rate of tax works out to be 20.93%. 20.936842%. Okay, this is the tax rate here. This is the tax rate which has been worked out. Now this is included just for calculation of rate purposes. Now we'll be computing the total income. Computation of total income of, who is she? Sujata. So it's PGBP income. She has earned PGBP in India 575, 5,75,000. This is GTI itself, less deduction under 80D, that is 25,000. 5,50,000 is the total income. Tax liability at rate of 20.936842% of 5,50,000 into 5,50,000. That is 1,15,150 rupees. This was when there was no agreement. Second one is also, there was an agreement. Second one is also show the tax payable by Sujata when there is no DTA. So when no DTAA exists, then relief will be provided under 91. Relief under section 91 will be provided on the doubly taxed income at the lower of the rates, Indian rate of tax or the rate of tax paid in foreign country. So when we work out to tax, say Indian income is how much? Indian income is, 5,75,000. Foreign income is how much? Foreign income is 14 lakhs. Foreign income is 14 lakhs. So it is 1975. This is GTI, less deduction under 80D. That is 35,000. Sorry, 25,000. It is total income 1950. Total income. We have calculated tax on total income, just we have calculated above. Tax on total income works out to be, 1950. The tax works out to be on 1950. It is, 1950. This is a calculation mistake. We have to see it. 1950. So it works out to be how much? 9,50,000 into 30%. It is 285. So this is 285 plus 112,500. That is 397,500 into 4% is 15,900. So entire calculation now changes. It works out to be 413,400. It is 413,400. So 413,400 divided by 19,50,000. into 100. 1950% is 21.2%. It is 21.20%. So here on 5,50,000, tax will be levied at 21.20%. That is 1,16,600. So you can just verify the calculation. If calculation is not correct, then please correct the same. Okay. Now here it is 116,600 in the first answer. Just we have seen now. Now tax on total income works out to be 413,400. 413,400. 413,400 including HEC less relief under section 91. We'll be providing relief under 91 of doubly tax income. Doubly tax income is what? 14 lakhs into Indian rate of tax. Indian rate of tax works out to be 21.2%. And on 14 lakhs, what is the rate of tax paid in foreign country? That is doubly tax income into Indian rate of tax, and doubly tax income into rate of tax paid in foreign country. What is the rate of tax paid in foreign country? Look, what is the rate of tax paid in foreign country is 20%. So lower will be this. That is 14 lakhs into 21.2%. That is 296. 800 here and 280 here. The lower will be, the relief will be provided 280 and a tax payable. 413,400 minus 280. That is 1,33,400 will be the tax payable. This was a simple question. You verify the calculation. It was relating to double taxation avoidance agreement and double taxation relief. How this is a commonly asked question in exam. So please do verify the calculation. Just we have seen one mistake, so you can verify it. So this was one question which we have discussed about this. The next one is the assessee received a notice under 148 stating reasons for reassessment. Okay, assessee has received a notice of income escaping assessment. The AO completed a reassessment based on fresh grounds that were different from the original assessments which prompted the reassessment. Now here, stating briefly, discuss the reassessment based on would be valid when the original reason which prompted the reassessment does not survive. Now here, this case has already been decided in Ranbaxy's case. In case the notice issued under 148, if a notice has been issued under 148 and if the original grounds for which the notice has been issued cannot survive, if the original grounds cannot survive, then in that particular case, the AO cannot make assessment for other income which has escaped assessment, and which comes to his notice subsequently. Because under section 147 it has been provided that AO can assess such income and any other income which comes to his notice subsequently. So first of all, the income which has escaped assessment and which formed a reason to believe, and the reasons have been recorded, the same must survive. Then only what the other aspects can, other income which has escaped assessment comes to his notice subsequently, he can issue that, you can make the assessment. This has been judicially decided by the Supreme Court said by Delhi High Court in Ranbaxy's case. Now, however, a contrary ruling has been also expressed by Punjab and Haryana High Court. In Punjab and Haryana High Court, in Mehak Finvest case, it has been decided by that AO can reassess the issues other than the issues in which, in respect of the proceedings, in which, say, 147 proceedings were initiated, even when the original reason to believe on basis of which notice was issued ceased to exist. So that these are two contrary views. So one way is what about the Ranbaxy's case? If Delhi High Court, which has decided AO cannot do that, and in Mehak Finvest case, however, the Punjab and Haryana High Court has decided that, the same can be done. Even if the original, say, the notice which initially found the basis, reasons for belief, the same could not survive while making the assessment, they can assess other income also, which comes to their notice subsequently. That has been the Punjab and Haryana's High Court view in Mehak Finvest case. So you can go through these, you can write both these cases relating to the views which have been expressed by Delhi High Court, as well as which has been expressed by the Punjab and Haryana High Court. So this was just for 2 marks, so you can go through the same. These cases are already covered in our book also, and in classes also we have discussed the same.